Good afternoon, Wealth Our Way Nation. What is going on? It is your man, Charles Tank Harris, the founder and chief visionary officer of the financial literacy platform, Wealth Our Way, where our motto is wealth is not only for the wealthy. Welcome to episode 25. This is the most underutilized tool in retirement planning. I'm going to drop it on you. We are going to cover it all week. I want to say thank you to each and every one of you who are live with us as we stream across the Wealth Our Way Facebook and YouTube pages. Give a special salute and shout out, as always, to Wealth Our Way Nation that watches the program pre-recorded overnight, over the weekend, or wherever they can squeeze 15 minutes of financial literacy in. And a heartfelt, how you doing? To my good folks on the Life 101 platform who always listen to the audio of this video broadcast. So with that being said, I hope you guys had a wonderful and amazing weekend. I know I did. Got a chance to take Georgia out, ride her down to Maryland and hang out with some of my Temple people. My boy, Big Trey, shout out to my man and his cousins. And then yesterday I rode into Philadelphia, Ride for Peace, to hopefully end some of this senseless gun violence that is going on, not just in my birth city of Philadelphia, the city of brotherly love, but across the nation. We do have to do our part to end this senseless violence. Just seeing the lives that were touched and shattered by deaths and violence, it's crazy. And anytime you get a chance to do your part, you should. So what are we talking about today? First of all, we're going to be talking for the next month or so about getting into the Wow Wealth Building Contest. So going across the bottom of the screen, I've updated the ticker. My technology game isn't always tight, but I figured out how to do it. And I want you guys to make sure you visit wealthourway.com for complete details of the contest. We will have that up before the day is over, the updated contest rules and regulations as we discussed a week or so ago. So we are talking about retirement. I've taken under advisement feedback that I have received for Wealth Our Way Nation about being able to take action, being able to get into the mindset and process of properly saving for our retirement. And I want to talk about, yes. See, Sister Lindsay wants this bread. We're going to get this money out there in these streets. 5 $200 winners of IRA contributions for the Wealth Building Contest. What I want to talk about today is a tool. If you've read the ebook, if you've listened to this program, you know it is my favorite building block for retirement success. And you have to know, without me putting it in the name of the title of today's broadcast, what it is. It is the Roth IRA. So I did a little screen share. We're going to pull it up. We're going to talk about the Roth IRA all week. We're going to talk about every element of it. When we are done with this week, you are going to be an expert on all things Roth IRA, because I get to understand from my audience and talking to people that it's one thing to hear me talk about it, to feel like I'm guiding you through a process, and then a whole nother thing when you're left alone, computer in your hands, need to call a company, need to sign up for an IRA, and a lot of the things that I've talked about and taught may go out the window. So we are going to hammer down on all things Roth IRA this week. And I'm going to be imploring you guys, as I always do, to put your questions in the chat, to make sure that anything that you are unclear of that we're covering gets further beaten down so that it's ingrained in your memory. So with that being said, let's go right to the screen share. I am going to do my best to slowly go through this information this week. I'm breaking down each screen share to just covering one part of the process of a Roth IRA, to not give too much information at one time. So for those of you who have a better grasp of the Roth IRA, this may seem a little slow, but I promise you throughout the 5 days of this week, we are going to cover any question that you have had or asked. I got a great article sent to me by my homie Brew, Temple University in the building, about Peter Thiel's Roth IRA being worth billions of dollars, and how the federal government is very upset that has come to pass, and how they are looking to alter the rules of the Roth IRA to make sure that something like what Peter Thiel did doesn't ever happen again. And that bothers me. You guys have heard me on this program talk about how our government should be 100% pro saving for retirement, 100% for you and me, mom and pop America, saving for retirement. Yeah, I'm here to tell you that anything that gets created, wealthy people and their advisors, they stare at it under a fine microscope to see what loopholes they can take advantage of. But when I look at how the government has restricted IRAs in general, and in particularly the Roth IRA, it bothers me because the income limitations on it, for starters, are so low. No one would consider a household to be wealthy where they phase you out of the Roth IRA. I really, really think they need to revisit some of these income limitations and contribution limits and help Americans save more for retirement. For those of you who have no idea what I'm talking about, when I mentioned Peter Thiel, let me give you a quick Reader's Digest version of what happened. Peter Thiel is a billionaire. He's one of the first people to have had invested in PayPal. He had the brilliant foresight and idea to put some of his PayPal investment into a Roth IRA. So Peter Thiel was able to convert. So he made too much money to do a Roth IRA straight. So he did a backdoor Roth IRA, which I talk to you guys about all the time. So he put, let's say it was $5,000 into a Roth IRA, into a traditional IRA, immediately converted it to a Roth IRA, and then purchased shares of PayPal pre-IPO in his self-directed Roth IRA. $5,000. Well, that money, or if he did more because he converted a bigger part of his IRA, that money is now worth $5 billion. And the IRS wants taxes on it. And they can't because of the way the Roth IRA is set up. He cannot be taxed on that money under the current laws. So now they are talking about change. This is what happens with the IRS. When they see someone play the game too well, they change the rules. Fortunately, if you've already gotten in, you're doing what's called being grandfathered in. They can't change the rules on you, but everybody who comes after you can have the rules changed. So now they're getting stricter on the size, or they're proposing to get stricter on the size of how big an IRA can grow. I'm totally against that, but I'm one person. Let's get into the screen share and talk about what IRAs are. So this is going to be Roth IRA 101 this week. We are going to get into the nitty gritty of every term on IRAs. We're going to talk about contribution limits. We're going to talk about what they are, how they work, how they can help you build your retirement, why I believe they are the most underutilized tool in retirement plan arsenals. So the first thing we need to understand is, what is a Roth IRA? So in order to understand what a Roth IRA is, let's understand what an IRA is. An IRA, I got to get my screen share game tight. An IRA is an individual retirement account. And an IRA allows you to contribute earned income. Very important that we understand it has to be earned income. Earned income is money you make from W-2 wages, tips, or other compensation, or business income in which you have an active role. Unearned passive income is not allowed to be contributed to an IRA. So that means dividends from your investment portfolio. That means rents, things of that nature. Anything that's passive, Social Security benefits, untaxed alimony, child support. Just because these monies have come into your life, if they are not considered earned income. I have clients of mine who are set up with life insurance policies that we bought from them when they were playing in the NBA, and now they're living off of the money tax-free from the policies. They can't contribute to an IRA with that money because it's unearned income when they receive it. So an IRA allows you to contribute earned income into a brokerage or bank account and purchase investments, or just leave the money in savings. One of the biggest questions I get is, should I open an IRA at my bank? I always tell people, everything that I say here on Wealth Our Way is general information. It's not designed to be individual information because you guys live in different states. You guys have different financial situations. For someone to come onto a broadcast like this one and try to give you individual information is reckless because they don't know your individual situation. So this is broad-based information. I get clients and prospective clients that call me and ask me, should they open their IRA at a bank or a brokerage firm? And the answer is it depends. Most banks, not all banks, but most banks only offer you savings vehicles, CDs, savings accounts, money market accounts. We've covered on previous programs that these types of accounts grow very, very slowly. They tend to be safer accounts because they'll never go down in value, but the interest that you get credited is very low in comparison to purchasing investments. Now, investments have the ability to lose money the same way they can gain money. They can go up and down, but over time, historically, they have shown to outpace the bank accounts like CDs, savings accounts, and money market accounts that are offered by banks. So you do have an option of purchasing investments or leaving the money in savings. While your funds are in your IRA, no tax occurs. So whether you're losing money, gaining money, it has no tax effect on you whatsoever while it is sheltered inside the IRA. Let's see what happens next. So we're going to talk about the traditional IRA first. If we're talking about a traditional IRA, any money that you contribute into your traditional IRA, you get a deduction on your income taxes. So when you make your money, it's called your gross income. Then you get to start to take itemized deductions and things of that nature. Once you start adjusting your gross income, it becomes your adjusted gross income. Your adjusted gross income is lowered or increased by different things that happen on your tax return. One of the things that lowers it is contributing to a traditional IRA. When you contribute, you get to subtract that money for tax purposes. But when you are done letting the money grow in a tax deferred account and you go to take it out in retirement, you are then taxed on the entire withdrawal based on what your tax rate is in that given year. So if you take $30,000 out and that's all the income you take out in that year, you will be seen as a person who has income of $30,000, whatever your tax bracket is, tax rate is in the future for a $30,000 withdrawal, you'll pay tax at that time. Now let's get the difference of what happens to that same type of account if it's a Roth IRA. If it is a Roth IRA, you get no deduction today. You are actually putting in money that has already been taxed. You get no deduction whatsoever. What happens though, the money grows without taxation the exact same way it does in a traditional IRA. It just grows and grows and grows. But when you take your withdrawal out with a Roth IRA, you pay no taxes whatsoever. So there is an inherent difference in deferring taxes, growing this account, and having to pay taxes at the finish line versus not having to pay taxes at the finish line. None of us have a crystal ball. None of us know what the tax rate is going to be next year or 10 years or 20 years from now. Actually, next year we do know because they're listed a year in advance. But in the future, we don't know where taxes are going. I think they're going to go higher. A lot of people agree. People think that they'll pay less taxes in retirement because they'll be living off less income than they live off of now. I have not found that to be a true example in my clients, my players, my small business owners. Expenses are still high. Inflation happens. You're going to pay taxes. You really want to consider an option that doesn't tax you in retirement. So that's the basic building block of a difference between a Roth IRA and a traditional IRA. Like I said, I'm taking it real slow this week because I want you to understand IRAs. I will be back tomorrow with part 2 of this week-long series of why the Roth IRA is the most underutilized tool in retirement planning. I'm looking forward to this week. We will have a guest before the week is over. I want you guys to have a great day. Come back tomorrow. And remember, here at Wealth Our Way, our motto is wealth is not only for the wealthy. Have a great